strategy where you set your position once per day. Just set it and forget it. A lot of you have emailed me and said, thanks for the strategy. It works just like you say it does. Do you have any other strategies for day trading? And the answer is yes. I can happily say that. And the Traded Day Forex day trading strategies is in the works and will be available late spring 2010. And for all of the enthusiasm, thank you very much. Right now, I want to take a little while and show you one of the strategies that will be explained in the new book. It's called Trading the 8 EMA. EMA stands for Exponential Moving Average. This is a fundamental trade that every Forex trader should be able to use. What's nice about this trade is that it is easy to spot, easy to enter, easy to exit, uses very small stop losses that allow you to get a little more aggressive by trading multiple lots. And it offers profit that ranges anywhere from small, 5, 6, 7, 8 pips. And I know that scalpers will like that a lot, to mid-range, 20, 21, 25 pips before price retraces, all the way up to long daily price runs of 100, 150, 250 pips. And perhaps the best thing is that this is available in all the pairs and often presents itself several times per day. As long as the price is moving, so too is the moving average, which goes without saying. And that is what we use here to enter and exit the trades. Okay, so what you're looking at here is the Australian dollar, US dollar, 15-minute pairing right here. And the green line you see running through the price action is the 8 exponential moving average. The difference between a simple moving average and an exponential moving average is that the exponential average gives a little more weight to the most recent data. And that makes it a little bit better of a predictor of what's going to happen next. This price right here, the 8, is what we use to enter and exit the trades. And you'll see here that the price makes meaningful moves up and down. The idea is to get into and out of these price moves or these mini trends as soon as possible and stay in them as long as possible. And so what you see here is that the price is constantly going somewhere. And as a result, it is either below the 8 moving average or above the 8 moving average. So the idea is to wait for one of these price moves to occur and then enter a trade when it closes on the opposite side. So let's start here. Here you see a meaningful move down. The price went down below the 8 moving average. It closed above right here. The idea is to buy here and stay in that trade until it closes back below it. After it closes back below it, enter short and stay in your short until it bounces back up and closes back above the 8 exponential moving average. Now, you may be thinking, is it really as simple as that? Well, yeah, it is, but not really. Let me add a new tool here. And hopefully this will show you a little bit better of how it works and how much longer you can stay in trades by entering and exiting on the 8, but also using the 21 period moving average. This red line right here is the 21 period moving average. And what you can see is that the 8 exponential moving average, because it is a shorter time frame, has the tendency of popping back above and below the 21 period moving average. So if we look at this trade right here, and we said, okay, we're going to get in after the price closes above the 8 exponential moving average and get out when it closes back below. That's a pretty simple trade. But let's go back a little bit in time here and find another one where it wasn't quite so simple. Here we go. This is perfect. If we look at the 8 exponential moving average here, we see that the price made a meaningful move up, popped back below, closed below the 8, and that's a sell signal. Our stop loss is going to be set against the previous candlestick's high plus 2 or 3 pips wiggle room. That means that we were going to enter here short and we were going to put our stop loss against this candlestick's high price Let's make this red. Our stop loss is here, plus 2 or 3 pips wiggle room. There we go. So we can see here that the entire stop loss for the trade is 15 pips. Call it 15 pips, 14.6 pips. So we'll call it 15 pips.